Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The Fed's holding pattern and a compressing Treasury curve are reshaping equity rotation strategies right now. Let's break down what the 3.50 to 3.75% funds rate hold means for your Q2 positioning, and why the 52 basis point yield spread between 2-year and 10-year treasuries is flashing critical signals for sector allocation. The Federal Open Market Committee held rates steady at their March 18th meeting, maintaining the 3.50 to 3.75% range. According to the official FOMC minutes from the Federal Reserve, this decision came nearly unanimously, representing a strategic pause after the rate cuts implemented in late 2025. Chairman Jerome Powell cited energy-driven inflation pressures stemming from the Iran conflict as the primary justification for this hold. That's not abstract policy speak. That's direct response to crude oil spiking from below $70 to above $100 per barrel in recent weeks. The Fed's communication strategy emphasizes what they're calling data clarity before further adjustments. Markets are interpreting this as prolonged accommodation, and that's creating clear winners and losers across sectors. Risk assets, including tech stocks and crypto, have responded positively to Powell's measured approach. The policy flexibility embedded in recent Fed statements tells you they're watching inflation dynamics and geopolitical developments, particularly energy markets, before making their next move. Now let's talk Treasury yields, because this is where the rubber meets the road for equity rotation. As of April 24th, according to ETF Trends Treasury Yield Snapshot, the 2-year sits at 3.79% and the 10-year at 4.31%. That 52 basis point spread is compressed, significantly flatter than historical norms, and it's signaling market expectations of economic deceleration or potential policy shifts ahead. Here's the critical context from bond market analysis by Chandler Asset Management. The yield curve was inverted from October 2022 through December 2024. It normalized about 7 months ago. Historical patterns show recessions typically emerge 1.5 to 6 months after normalization, with lead times ranging from 18 to 92 weeks. We're sitting in that observation window right now. The flattening trend we're seeing in April 2026 mirrors patterns that preceded previous economic slowdowns, though the current environment is complicated by geopolitical factors that distinguish it from purely domestic cycles. So what does this mean for sector rotation? Technology megacaps are the clear beneficiaries of sustained low borrowing costs. With the Fed maintaining accommodative policy amid uncertainty, tech companies with strong balance sheets and robust earnings expectations are attracting capital flows. Market analysts are projecting potential upside of 10 to 25% for technology equities, driven by 3 factors. 1, continued low funding costs supporting growth valuations. 2, strong earnings expectations relative to other sectors. 3, investor preference for growth over value when economic visibility is limited. Contrast that with financials. The compressed yield curve is creating significant headwinds. Banks and financial institutions face margin pressure from limited net interest income opportunities. That 52 basis point spread between 2-year and 10-year treasuries provides minimal room for traditional banking profit models that rely on borrowing short and lending long. This dynamic supports rotation away from financial sector exposure in favor of sectors less sensitive to rate spreads. Energy and commodities present a different opportunity set. Geopolitical tensions, particularly the Iran conflict, have driven crude above $100 per barrel. According to PFM Asset Management's monthly market review, these sectors serve as inflation hedges and benefit from supply disruption premiums. Energy rotation strategies currently focus on companies positioned to benefit from higher commodity prices while maintaining operational flexibility in volatile geopolitical environments. Let's connect the dots across asset classes. The Fed's accommodative stance is supporting risk on sentiment broadly. Cryptocurrency markets have responded positively, reflecting broader appetite for alternative investments when traditional yield opportunities appear constrained. Foreign exchange markets have adjusted to capital flows favoring risk assets, creating implications for international equity rotation and currency hedging considerations. The credit market environment, while showing limited specific spread data, suggests continued accommodation in corporate credit. This supports equity valuations across sectors while maintaining differentiation based on interest rate sensitivity and growth prospects. That differentiation is key to tactical positioning right now. Here's your strategic framework for Q2. Current conditions favor rotation toward three areas. Technology, benefiting from low rates and growth premium. Energy and commodities, providing inflation, hedge, and geopolitical premium. Growth-oriented sectors broadly, supported by accommodative monetary policy. Sectors to underweight or monitor carefully include financials pressured by the flattened curve, interest rate-sensitive sectors vulnerable to yield dynamics, and international exposures subject to currency and geopolitical risks. Risk considerations you need to factor into allocation decisions. Geopolitical escalation affecting energy markets remains the primary tail risk. Inflation persistence could force Fed policy adjustment faster than current market pricing suggests. Yield curve inversion recurrence would signal heightened recession risk. And credit market stress from prolonged accommodation could emerge if economic conditions deteriorate while rates remain accommodative. The numbers that matter right now. Federal funds rate 3.50 to 3.75%, held since March. 2-year Treasury 3.79%. 10-year Treasury 4.31%. Yield spread 52 basis points. Crude oil above $100 per barrel after spiking from sub-$70 levels. Critical dates for context. March 18th, FOMC rate hold decision. April 24th, latest Treasury yield snapshot. October 2022 through December 2024, previous inversion period. And we're currently in Q2 2026, the strategic planning period for these rotation strategies. According to analysis from Raymond James Bond Market Commentary, the current environment creates a unique framework for tactical allocation. You're balancing growth opportunities against recession risk, inflation hedging against rate sensitivity, and geopolitical premiums against traditional economic fundamentals. The takeaway for active traders is clear. The Fed's hold pattern combined with yield curve compression creates sector divergence that's actionable right now. Technology and energy are positioned for outperformance. Financials face structural headwinds, and the clock is ticking on yield curve normalization patterns that historically precede economic slowdowns. Position sizing matters in this environment. The growth premium in tech is supported by policy accommodation, but you're trading against recession signals from the curve. Energy provides inflation, protection, and geopolitical premium, but you're exposed to conflict resolution risk. The compressed 52 basis point spread tells you markets are pricing in either economic deceleration or policy adjustment, both of which have implications for sector leadership. Monitor Fed communications closely. Any shift in Powell's messaging around inflation or geopolitical risks will move the rate expectation curve and impact sector rotation dynamics immediately. Watch Treasury yield movements daily. If the curve flattens further or reinverts, that changes the recession probability calculus and should trigger defensive positioning. Track energy prices and geopolitical developments, as crude oil dynamics are directly influencing Fed policy stance and inflation expectations. The cross-asset implications extend beyond equities. Credit spreads, currency moves, and commodity positioning that all tie back to this central tension between accommodative policy and yield curve recession signals. That's creating volatility and opportunity across markets. For Q2 positioning, the bias favors growth and inflation hedges over rate-sensitive value plays. The data supports overweight technology for policy tailwinds and earnings strength, tactical energy exposure for geopolitical premium and inflation protection, and underweight financials given structural margin pressure from curve compression. This isn't a set-it-and-forget-it environment. The next FOMC meeting, Treasury auctions, geopolitical developments, and inflation prints will all provide inflection points for adjusting tactical allocations. The framework is clear, the signals are actionable, and the sector divergence is creating tradable opportunities right now. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.